Hey everybody, hope everyone's doing well and had a good day overall. We're starting to go sideways at the September the 6th higher low down here. Let me do this really quick. I'm going to turn on the pointer so you guys can see my screen. One second here. There we go. For some reason, the pointer was not wanting to turn on the red circle over the mouse. Anyways, we had a trading range. We broke below the downside. We're testing the September the 6th low right here. The bears, they're at support, and this is basically a 10% correction. So overall, I think the odds are we're probably due for a bounce. No one knows how far the bounce is going to be, but realistically, think about it like this. If the odds are the market's going to pull back and at least bounce for a bar or two, if you're trading, and theoretically, if you can manage the trade quickly, a lot of traders would exit the trade. So for example, that's why Al says I'd get out above a bull bar, because bears would exit and then wait for a couple of legs sideways to up. And you don't know how deep the correction, the pullback could be. We could get a series of bull bars and then a higher low and then a sharp reversal, or we could get a couple of legs sideways to up and a second leg down. That's the question I think that's on everybody's mind. As good as this is, it's late in a sell-off, and just look at this right here. Do you really want to sell the close down here? Probably not. The risk is relatively big, and you have to ask yourself, what's the probability that the market's going to go all the way here before it pulls back? And I think the odds are we're probably going to pull back first. And that's why I think the daily chart is likely to bounce. On the 5-minute chart, we had yesterday's low all the way down here, and we never reached it. Bar one, we gapped up. It's a second leg up from this rally from yesterday's 66, and therefore it's a double top. The bulls, they want to break above one, and even if two leads to a pullback, they want to break out and then a second leg up. And then two, we have a bear bar, doji, overlap, starting to go sideways. A reminder that we're still in the overall trading range. But because of the gap up, I think we may, we'll probably go above the one high. Technically, one is follow through from the gap, so probably buyers below in a second leg. But realistically, do you want to buy right here? The risk is relatively big, and the profit potential is probably small. And then three, bear breakout below the tight trading range, bear breakout, probably going to get a second leg down below three, therefore probably sellers above four and a second leg. Four, that met the minimum of a second leg down after three. Bar four, it's a doji, and therefore I suspect will probably bounce. But realistically, who's going to buy above four? One of the things I always talk about, I talked a lot about it in the trading room yesterday. You can go back on the recording and listen to it. Is I talked about the importance of stop entries and always thinking about, if you had to pick, would you buy above this bar or sell below this bar? And right here, when you look at bar four, that's a bad buy above, and therefore it's probably better sell above the bar. Four, almost outside down, breakout, pullback, sell. You can call it a low one. Good for the bears, probably going at least a little bit lower, so probably sellers below. even if the market pulls back first. I suspect we'll get a second leg down. The bulls, they want buyers below the 5 low, and you get a reversal. But we have a tight bear channel, and it's a difficult trade for the bears. Why is it difficult? Because of this. If it's a difficult trade for the bulls. The reason is if you sell below 5 and you put a stop 1 tick above, 1 times your risk is this. And you've probably got better than a 50-50 chance of reaching that. And therefore, buying the 5 low, setting a target up here, stop down here, I think has worse probability than traders selling and doing the opposite. 6, bear breakout. So the bulls who bought the 5 low and more lower disappointed with 6. They wanted a quick reversal and we didn't get it. And therefore, that increases the odds that there's sellers above 6 and possibly on the 6 close. 7, we broke below 6, but because of the 6 low below, we found buyers. We're starting to find buyers below bars. And because of that, it increases the chances that we're probably going to bounce. Are we going to bounce all that far? It's possible, but the bulls need a series of bull bars. 1 bull bar closing above 6 or 7 is not going to be enough. 8, bull bar closing on its high. For the bulls, it's a parabolic wedge bottom. 1, 4, and 7. They want a bull breakout and a rally up to the 5 high, but only 1 bull bar since bar 1, and the channel down is relatively tight. That makes me think that there's probably sellers above the 1 high. Bar 7 is a bad buy signal bar, and we'll probably have to pull back. 9, outside down, good for the bears, but probably buyers below 8 and buyers below 9, scaling in lower, but the buyers may not come in until 7 low. 10, a bear bar, but a close well above the midpoint. What about buying above 10? Not really that great of a bar to buy above. It's a bear bar, and therefore it increases the risk that there's sellers above the bar. Outside down on 11, good for the bears, second leg down from the sell-off that began on 9. Possible double bottom, 7 and 11, but a tight trading range, possible triangle in a final that could lead to a final flag and a bear breakout below. We had a bear breakout down to 6, we're forming a trading range. It's possible we get trend resumption, so leg 1, trading range, trend resumption. 12, bull bar, but not a lot of traders are going to buy above 12. Lowers the probability for the bulls and increases the odds of sellers above. 13, bear breakout of the triangle here, and therefore bear breakout of the tight trading range. Strong enough breakout, probably going to go at least a little bit lower. Follow through, good for the bears. Probably sell the close for at least a second leg down. 15, bear breakout, body bigger than 14. That is a sign of climactic behavior. Increases the odds that we may pull back, but realistically, it's still sell to close, sellers above. But because of the tail from 15, probably going to pull back soon. And then 16, a bear bar, but body getting smaller. Looks like we're going to bounce. We're at a logical magnet. Yesterday's 78 close and the close of 81. Bulls want a double bottom, higher low, and they want a double bottom and then reversal up, but very tight channel. That's a breakout on a higher time frame, and it'll probably lead to some kind of second leg. So there's increased risk that if we do bounce, there's sellers around 50%. Bull bar on 17, good for the bulls, but only 1 bull bar, similar to bar 8. There might be more sellers above than buyers. And then 18, strong reversal down, probably going at least a little bit lower. But what do you notice? We have a sell-off on 7, sell-off 16, sell-off 18. That's a parabolic wedge, and it's a possible fail breakout below 78 low. As far as bulls buying it, some bulls will buy it. Generally, for me, when I see a breakout bar like 18, I'd rather wait and see the stop entry. In other words, I'd wait and see the reversal. 19 consecutive bear bars. It's technically selling the close, but bottom of the possible, but 3 legs down. And therefore, we could get a reversal up at any time. 20, bear bar, close above the midpoint, increases the risk that we get some kind of reversal up. We're low in the overall trading range. Low in the overall trading range, and that increases the risk that the market is going to pull back. $21, reversal bar, good for the bulls, but a bad low 1 for the bears. Not a great buy signal bar. It's a micro channel with 17 down to 20, and therefore it increases the risk of sellers above 21. But the problem with selling above 21 is you got to think about it like this. If you sell the 21 high, are you going to sell below the 21 low? Probably not. 21's a low 1 short, and therefore you know that if it's a bad low 1 short after 3 legs down, there's probably more traders buying below it than selling it, and therefore That is a low probability sell, which means the risk reward is bad for the bears. If you're a bear and you're selling anywhere in here, the profit potential is there's probably buyers below 21, and therefore how much risk are you willing to make if the best you're going to get is maybe the low of 21 and possibly the low of 20. That is not a lot of reward relative to risk. So that would be 1 times your risk here. And because of that, I think the odds are starting to favor a test to the upside, far from the moving average. And it's kind of what's going on the daily chart. It's the same overall logic. We have a series of sell climaxes here, here, and here. And now we have this low 1 short. And you look at that low 1 and you think, wow, what a terrible bar to sell below. And that's true. It is a bad bar to sell below. And because of that, you have a low 1 short with a bad sell signal bar to sell below the bar. How much risk, if you think that there's probably buyers below today's low, how much risk are you willing to accept? So there's buyers probably below the bar. Are you going to put a stop right here? That would be 1 times your risk theoretically. Are you going to put a stop at twice your risk? And that's the issue. There's probably buyers down here, and the risk is really, really big. And because of that, it's probably favoring the other traders. So it's probably favoring traders who are willing to buy in the bottom third of this bar, put a stop somewhere down here, maybe 55, 5,300, 50, 5450, somewhere in there, betting on a bounce. So apply that to the 5-minute chart. There's probably more traders buying down here with a wide stop, betting on that they can make 1 times the risk. Bull bar, you can see a lot of traders buying near the 21 low. There were so many traders trying to buy the 21 low that a lot of traders bought a couple of ticks above the 21 low. So instead of buying the 21 low, they put a limit order to buy maybe 2 or 3 ticks above the 21 low and got filled on 22. 22 reversal bar. Good for the bulls, probably going to get at least a small second leg up, and therefore probably buyers for at least a bounce. And then 23 bull bar, but an over. You can see what happened. Bears who sold the high at 21 and more higher on 22 or 23 made money. 3 consecutive bull bars, but we're getting tails below bars. Tails below 22, tails below 23 increases the risk that we may pull back. But after 3 consecutive bull bars, I suspect we're going to get a second leg up. 24, 4 consecutive bull bars, good for the bulls. Is it buy the close? I think it is, especially if you can use a wide stop and scale in. 25, bull bar, but body's getting smaller, so probably going to pull back here. And then 26, another bull bar, good for the bulls. Still buy the close. With all these tails, it's basically a spike pullback channel, and it's a micro channel on this time frame. Micro channels are always broader channels or tight channels on smaller time frames. Even though the odds are the market's probably going to pull back, you have to look at this and think, we're getting a lot of bull bars with tails above, but why aren't we pulling back? And the reason we're not pulling back is because there's so many traders interested in buying in this overall price level that there's so many traders interested in buying in this overall area that the bulls are uninterested in. Let me say it differently because I'm messing it up here. There's so many traders interested in buying in this overall area that they're not allowing a pullback. If everyone wants to buy a pullback, then a pullback's not going to happen, and therefore traders are buying small reversals during the bar to at least minimize risk. Doji 27, probably buyers below, and then 28 bull breakout, good for the bulls, still probably going higher. You can see what happened. 30 is starting to change the characteristic a little bit. 30 broke to the downside and found buyers. Why is that? Because you had a doji 27, and whenever you get inside bars, they're basically final flags, and the market usually tests back within 1 to 3 bars. With 30, that increases the chances that traders are going to start taking profits above bars. Is there any reason to be selling below bars? Absolutely not. Channel's way too strong. Bull bar 32, good for the bulls, still probably going higher. 33, bull breakout, good for the bulls. But you see what's happening. Traders are buying pullbacks of bars rather than buying closes. 34, another pullback bar. High 1 buy, 34. There's probably sellers above and will go sideways, but the channel up is so tight that I don't think many traders are going to be interested in selling. So it's probably better to wait for a pullback and then buy reversal up. Small second leg up, 35, good for the bulls. And then we tried to reverse down 36, but not a good reversal bar, so probably buyers below. 37, bull bar, and then you can see what happened with 38. 38, we reversed down. For the bears, it's basically a wedge. Rally to 30, pull back, second leg 33, pull back, third leg 37. It's a parabolic wedge, and therefore parabolic wedges typically lead to minor reversals, and therefore probably buyers below. But when you get a bear bar closing on its low, it's an issue of risk. You have to ask yourself, what's the probability if a bear is willing to, well, let me do it like this. So what's the probability if you're a bull and you buy the close at this bear bar and you set a target at the high of the bar and you put a stop at 1 times the range down? What's the probability you're going to make money? It's probably not 40%, and therefore it's probably a lot closer to 50-50. And because of that, it actually makes a lot of sense from a risk reward standpoint for bulls to get out of longs below 37, and therefore bears, they'll sell below 37, taking a chance we get a reversal. And the reason for that is risk reward. Nobody's going to put a stop all the way down here below 30. And the reality is, if you're buying up here, you're trading small and scaling in. And it's a really difficult thing to manage. It's kind of like this right here. Let's say you buy the one low. It doesn't make a lot of sense to put a stop below 70, 79 from yesterday. Why? Because your risk would be massive and it'd be really big. And the problem with that is if we fall below yesterday's 78, look what happened. The market reversed back up. So here, it doesn't make sense to put a stop below 30 because realistically, if we fall below 30, there's going to be buyers below 30. And therefore, a lot of traders get out, wait for the momentum to slow down, and then re-enter. Good bar for the bears, 39, but it's a very big bar in a climactic bar. And climactic bars really are not your friend when it comes to trading ranges. This actually increases the risk that there's going to be more traders buying 39 than selling it. So it's actually more of a dangerous bar for the bears to sell. Bull bar, 40. For the bulls, strong enough reversal, probably a second leg up, but 39 was enough of a surprise that we may have to test the 39 close first. And you can see what happened with 41. 40 reversed up, 41 pulled back, and then went up. So it's a trend line break from 40. That's good for the bears and increases the odds that there might be sellers above 40, and we get a second leg down testing 39. A lot of traders are not going to buy the first reversal down after 40. But because 41 went down and then went up, it's basically a trend line break. You can think about it as a higher high major trend reversal on a smaller time frame, and therefore they'll be more inclined to take the sell. It's kind of like this over here. A lot of traders, when they see 63, 64, 65, they're not going to sell below 66 because they know the odds are the first reversal down is going to be minor. But when they see 66, 67, and then the reversal up 68, they'll be more willing to sell the second reversal down. 42, good for the bears, but probably going to go sideways. If anything, I'd like to see 43 be a strong bear bar, and instead it's not. It's a bull bar, and that increases the chances. While there might be sellers above 43, and we test down below 43, I suspect there's buyers not far below 43. If 42 is such a strong bar for the bears, why did the market go sideways? 44, outside up, good for the bulls, probably always in bears, always in bulls. I think it's reasonable for always in bulls to buy, and therefore always in bears exit. There's shorts above the bar. 45, good for the bulls, probably going at least a little bit higher. 46, doji, and you can see we're starting to stall and go sideways. For the bears, it's a possible double top, 41, 46, but a weak sell signal bar below 46, probably buyers below. 47, bull breakout, good for the bulls, but probably more traders selling above 41 than buying it. Micro channel, a little bit dangerous to sell, probably going to go above the 38 high. But a lot of bulls up here are nervous because 39 had a lot of momentum down, and that increases the odds that we're in a trading range. 48, good for the bulls. You can see you had bears who sold the 41 high during 47, and they were disappointed by the close of 47 that they exited the trade. 48 went down and then reversed back up. 48, bull bar, good for the bulls. Probably going to go at least a little bit higher. For the risk for the bulls is 2 legs up, 45, pause, 48. And then we got a doji, 49, but a weak buy, probably going to get a second leg up. And then 49, 50, 51, 3 consecutive bear bars. Possible fail breakout of the 37 high. After 51, I think a lot of bulls would probably get out below the bar. It's a reversal, and because you're in a trading range, you could test all the way back down here. So for the bears, possible higher high major trend reversal, trend line break, pull back to a higher high major trend reversal. 52, 4 consecutive bear bars, probably going at least a little bit lower, and we broke to the downside. 53, 54, 53, 54, good for the bears. Is it sell to close? It might be sell to close, but this is always one of the risks. In general, you can sell the close betting that the market's going to go lower. But one of the problems with it is it's actually 2 attempts down. We sold off, we rallied, sold off, rallied again, and we're selling off fairly strong. Now, what about buying 54? Well, the reality is you're buying a pretty strong breakout, and I think that's a fairly dangerous thing to do. So I think it's an okay sell, but if you get a bull bar closing on a tie or some kind of second entry, you could probably get out. 55, bull reversal, but not a strong buy above, so probably sellers above the bar. 56, a doji, probably buyers below, and at least a pullback, so therefore you'll have some traders buying down here. And then 57, reversal up, good for the bulls. Probably sellers above 57, but a bull bar closing on a tie, and there's probably buyers in the bottom third of 57, and therefore I think it's reasonable for always in bears to get out above 57 and wait for a bear bar. 58, follow through. More bears will probably start buying back their shorts. And you can see what happened. The bears, they never got a reasonable sell signal. For the bears parabolic wedge, 55, 57, 63, but a bad stop entry, probably buyers below. And then 62, and then 63, bull breakout, the parabolic wedge, follow through, but you're right at the top of the trading range, and this might be 3 legs up, 37, 49, 63. And then bear bar, 64. You had some bulls who bought the close 63, disappointed 64, and they'll probably try and get out, break even. And that's what happened with 66. 66, bad high one buy, probably sellers above, second leg down. 67, second leg down after 65. For the bulls, they'll see it as 2 legs down, leg 1, pull back, leg 2. But a bad stop entry above 67 increases the risk that we go lower. 68, doji, but a bad buy signal bar. If the bulls were all that strong, why are we getting bad buy signal bars? And that's because they're not strong enough to buy here. Otherwise, we'd have strong bull bars closing on our highs. 69, outside down, probably going to go at least. We may go a little bit lower. For always in bulls, if you're long, I think it's wise to get out below a bear bar 69, even though it's bottom of this possible trading range. And then 70, reversal up. For the bears, you can argue 2 or 3 legs down. For the bulls, but a weak buy signal bar 70 increases the odds of sellers above in some kind of bear breakout. In other words, kind of like over here, we have a wedge 67, 71, and then 75, but 3 pushes down with 3 bar micro channel 69, 70, 71, 75. Even though it looks good for the bulls, it's actually a weaker buy signal bar. And then 76 pulled back more than it went up, and that's a sign of weakness as well. And so we might be getting something like that over here. 72, not a good buy signal bar above, so it looks like we're probably going to pull. So increase the risk of sellers above. 73, outside down, good for the bears. Whenever you get a low one like 72, typically the market pulls back and then gets resumption, and that increases the risk that we may try and break out below 71. 74, doji, you can see more traders buying below 73 than selling, so it looks like we're probably going to go sideways into the close. And you can see that's basically what happened for the rest of the day. For stop entries, I thought the first credible sell was probably selling below 5. Otherwise, there's probably no reasonable buys over here, and therefore the next stop entry is probably selling below 13 or 14. The follow through from the triangle breakout here. You can sell below 18, but third leg down, so you got to be quick to get out above a bull bar. Always in bulls, they can buy above 21. I think higher probability to wait for a series of bull bars like 22 or 23 and then start buying. And then where do the bulls get out? I think they get out below 38. But if they do they buy again above 40? Some might. But if you're buying above 40, you really need a wide stop. And 40 is a lot of risk relative to the reward. Therefore, it's probably better to wait for a second entry, especially after 38 and 39. 44, always in bears, get out. In bulls, they can buy, but then they probably get out below the series of 3 consecutive bear bars. They get out below 50, 51, or 52. I thought 51 made a decent amount of sense. not a lot of traders are probably going to buy on a stop above 51, and therefore it's probably better to exit longs and look to buy a pullback. Bears, some will sell, but if they do, they probably get up above 57 or 58. Bulls, they can go long if they're aggressive. 1 minute. So bears get out 57, 58. Bulls, they can be long, but they probably get out below bear bar 69. And if they do, there's really no decent buy again. Plus, it's too late in the day. Limit orders, sellers above 4, and probably, let's see where else. You could argue sellers above 4, sellers above 10, sellers above 16, buyers below 21. I thought buyers below 29. And then up here, probably sellers above 35, betting on some sort of 3-push pattern. And then probably buyers below 41 for a second leg, and then probably buyers below here, sellers above. But when you get getting late in the day, I think it's better to probably do nothing. Buy the close, sell the close. Probably sell the close, maybe bar 4, but you need to be able to scale in. It's not ideal. I thought the most reasonable sell the close was probably 13 or better 14 for a second leg down. You can sell the close 18 or 19, but 3 legs down. If you do, you got to get out of the bull bar. And then it's basically buy the close anywhere in here for a second leg up. 33, you can argue buy the close, but getting high in the range and getting a lot of overlap, so it increases the odds we're probably going to pull back soon. And then sell the close 53, sell the close 54, but bars are big in the middle, basically the midpoint after a strong rally, so a little bit dangerous of an area to be selling. And then as far as buy the close up here, I think it's really, really difficult. You can buy 58, but it's still not all that clear. And even 60, 61, it's not all that clear either. What do you do if 62 is a bear bar closing on its low? It probably makes sense to get out of the longs. And that's probably it for buy the close, sell the close. So where do we go tomorrow? I think we're probably going to bounce. Remember what I said, it's a bad low one short below the bar, and that increases the chances of buyers below and a second leg up. All right, thanks everyone, and hope everyone has a good evening.